Find out if the market is overvalued or not. Have you ever wondered before investing if the market is overvalued or not? It is imperative to know about the market situation before investing.
Audio Jungle.
It's common knowledge among those who trade stocks that the market alternates between euphoria and fear. Investors keep piling into stocks during a bull market because they expect the price to rise. This is when the whole market is technically overpriced. Fearful investors act similarly, selling off their shares, resulting in a depressed stock price. The issue is that it takes hindsight to recognize inflated or undervalued markets. The majority of investors think the current market price is reasonable. Overvalued markets usually prompt experts to explain why this time is different and why overvalued markets are here to stay. So, if an investor can reliably tell whether a market is overvalued, they will have a significant advantage over their competitors. The purpose of this video is to take a deeper look at some of the indicators that investors can use to spot overvalued markets. If you are a new investor and do not know how to find an overvalued or undervalued market, then you must stick to the end of this video to do a good investment, because we're going to explain what exactly is Indian stock market valuation all about. What are overvalued and undervalued stocks? What does a stock market overvalued bubble mean? How to identify an overvalued market? Using appropriate benchmarks allows you to spot a market that is overvalued. The market's PE ratio is a good indicator of whether or not the market is overvalued. This ratio is the same as if we were evaluating just one stock. Many experts conclude the economy using this easily accessible number. The price-earnings ratio of the whole market is determined by taking a weighted average of the ratios of the individual stocks that make up the index. The price-earnings ratio often hovers close to its average level. In other words, the average price-earnings ratio is what you should expect if you base your calculations on past data. The market is overvalued if the current PE ratio is much higher than the average PE ratio in the last 10 years. This is what caused the Great Depression, the dot-com boom, and the Great Recession of 2008. The second most reliable way to tell if a market is overvalued is to look at the ratio of the total market capitalization to the GDP. When things are done on a daily basis, the market cap is quite close to the GDP. This ratio's drop below 0.7 may signal an undervalued market that might be good for investors to get into. However, the market is considered overvalued if the ratio rises beyond 1.25. This ratio can't be easily determined, since the data needed to do so is not freely accessible. The good news is that there is a solution. Politically neutral institutions like the World Bank regularly disseminate this information. This number remains relatively high from day to day. Therefore, once every 3 months is enough. Understanding the meaning of overvaluation and undervaluation. It's important to remember that there is no one right way to figure out why market values change. In the same way that an entire market might be overvalued, a particular sector or even a few companies can be undervalued. Inferences drawn from this data should, however, be taken with caution. The market's overvaluation is not always a precursor to a steep decline. This means one should not blindly short the market because specific ratios say it is overvalued. In the long term, overvalued markets tend to go back to their average. Nonetheless, more value growth is quite probable soon. It is a known fact that the markets can stay crazy for as long as you can keep your business afloat. To the extent possible, gamble with the resources you now possess. Putting a time limit on your activities is another mistake you should avoid. Specific markets may seem chronically undervalued if these criteria are used. Nonetheless, other circumstances may lead to their worth being underestimated. For instance, certain nations' political and military stability is always in question. Since this is the case, investors are wary of putting money into these nations. When comparing a country's GDP to its market capitalization, it may seem undervalued. On the other hand, nothing will probably change in this regard for at least the next several years. This is because political unrest is the root reason for the undervaluation, which is not considered in the statistic. These two criteria do help to tell the difference between markets that are overvalued and those that are undervalued. While the advice is helpful, it should not be taken at face value. This is because other elements are at play. Investment choices should only be made after careful consideration of such variables. Is the Indian stock market overvalued or undervalued? The Indian stock market reached all-time highs in various measures in 2021. The BSE Sensex hit a high of 62,245 in October and remained above the 57,000 level until the end of trading in December. In 2022, technical experts say that if the Nifty keeps trading above the 18,100 level, it will reach a record high of 18,604. The Nifty Bank Index is expected to rise past its previous record high of 41,840 points soon. But even if economic impediments have remained, these indexes have done remarkably well, and that's why experts say the Indian stock market is likely in a bubble right now. What does it mean if a stock is overvalued or undervalued? The PE ratio shows that a stock is overvalued if its price is much higher than its value. This is often done by taking the long-term average PE ratio into account. Conversely, an undervalued stock trades for much less than its actual value. A stock market bubble. What is it? When the market price of a stock or other financial asset becomes irrationally high relative to its underlying value, it is said to be in bubble territory. When a stock's price stays artificially high for a long time, this is called a bubble. Speculative and opportunistic purchasing is often to blame when a bubble develops. Investors are to blame for pushing stocks into bubble territory. Investors who believe a stock's price will climb will likely purchase more of that stock, driving its price much above its intrinsic value. When a bubble bursts, people tend to sell their shares quickly, which lowers demand and raises supply. This causes share prices to fall rapidly. Therefore, potential losses are higher since the bubble might pop at any moment. The most well-known example of a drop is the collapse of the American housing market in 2007. Which are the indicators to know overvalued or undervalued stock market? It's not easy to tell whether a stock is expensive. On the other hand, analysts and economists use a wide range of indexes to figure out how things are going. These are the indicators to determine whether the stock is overvalued or not. Number 1. Stock market capital to GDP ratio. How overvalued or undervalued the stock market is can be determined by comparing it to the country's gross domestic product, GDP. The ratio is calculated by dividing the current stock market capitalization or total market capitalization of listed enterprises by GDP. A market is undervalued if its value is between 50 and 75%, below its true worth. A range of 75 to 90% is reasonable. Many people consider a market overpriced if its value rises beyond 100%. The Buffett indicator is another name for the ratio. Number 2. Price to earnings ratio. It is calculated by dividing the company's share price by its earnings per share. It informs buyers and sellers about the over or undervaluation of a stock. Investors should avoid companies with a high price to earnings ratio. Before jumping to third indicator in our list, please hit the thumbs up icon if you like our video. Number 3. Price to book value per share. A company's profitability can be gauged by looking at the price of its shares relative to its book value. Conservative investors use it to figure out how much of a safety margin they have. The price to book ratio (PB) is calculated by dividing the current share price by the company's book value per share from the most recent fiscal quarter. Is the Indian stock market overvalued right now or not? Even though the Indian market is similar, it is massively overvalued compared to other markets. The valuations in the Indian market are more than 120% higher than those of the developing market index. It is tough for this to sustain. Whatever story you build out, caution has to be exercised and people need to keep some cash so that one is ready to buy in a sudden sell-off. Here are some other indicators that the market has been experiencing a bubble for some time. The stock market was overvalued as of March 21. According to the Reserve Bank of India's assessment for 2020-21, Governor Shaktikanta Das issued a similar warning to the investing public in August 2021. The markets continue to increase steadily, even though the economy is still recovering from the consequences of the COVID outbreak. This increase is the result of an overvalued market. India's market capitalization as a percentage of GDP hit an all-time high of 188% in September. Initial public offerings (IPOs) were plentiful in 2021. Companies like Zomato and Paytm have gone public. A shift in public opinion boosted stock market demand. Initial public offerings (IPOs) have increased profit, leading to a rise in the number of people opening Demat accounts, which has doubled in the last year. Total debt as a percentage of GDP was 58.73% at the end of FY 2020-21. Any market that approaches or reaches this high a figure is likely overpriced. How secure are stock investments at the moment? Yes, your investments are secure, but only if you exercise the cautions. When markets are overvalued, investors are cautioned not to act impulsively and instead think things out. This is the case even when markets seem to be cheap, because if you're not careful, you might seriously damage your financial situation in any scenario. Even if their value doesn't appear too high, high-quality stocks deliver greater profits even when burst, making them a superior choice for long-term investor bubbles. Thus, it would help if you exercised caution now to succeed in this competitive industry. One should also be aware of the worth of the Indian rupee. When the rupee begins to fall in value steadily over time, it is often a sign that the market is significantly undervalued. That's because if FII investors see their dollar-based profits diminish, they may decide to cash out. This has happened several times before, most recently in 2018. You should just keep an eye out for any changes in these parameters. To get the most up-to-date information about investments in stocks and financial knowledge from Omega Finance, please hit the bell icon and subscribe to this channel. Tell us in the comment section about your preferred way of market valuation. We have also uploaded a video on stock valuation on our channel, which can be very helpful to you for finding the PE ratio and other ratios to know the undervalued and overvalued stocks. You can find the link to that video in the description below and in the card.